Right. Morning traders. Welcome back to Morning Cup by 8. Aiman here. All right. So, good news for the market today. You see the S&P 500 close strongly, pushed higher by the big tech surprise. The Nvidia's 5 billion investment in Intel, and also reinforced by more dovish signal from the Fed, suggesting the rate cuts ahead. Right. So, tech and AI names are leading right now. We're seeing record highs. I mean, sectors like semicons, cloud, yeah, are still in favor. So, still remain cautious about the stretch valuations and also any inflation surprises, right? So, if you see here, the key support is it the recent lows right now. So resistance at new highs. Also, touching a bit on the ETF S&P 500, the SSO, we believe that the 6,700 points is now isn't that far from the current price. So, using the same Fibonacci scale, we might be able to catch around 3 to 5% gains from the ETF. Right. So looking at the economic data happening next week. So we have few in the list right now. I think investors are eyeing for the GDP, jobless claims, and also the PC data to gauge the monthly inflation factors, which somehow could help to navigate the market. I think it should be on tentatively on Thursday and also Friday, right? So the China A50 index, I think recently has the overall has rallied recently, which we think due to rotation from bonds into equities, and hope that China economy may be stabilizing, but it's facing a challenge or a headwind at the moment. The regulatory pressures around the semicon are raising, especially with the new um, investigation and bans targeting the US chip export and also chip usage by Chinese tech firm, right? So technically the index has rejected the resistance zones. Market are now showing signs of cautious back. I think at this point, momentum remains positive, where we see that the current pullback as a normal technical correction before it rebound higher. So ETF 2823 showing a good signal here, rejecting the 20-day moving average. Right, so looking at the WTI crude price, well, it is holding near 63, 64 US dollar level after a strong drawdown in US crude stockpiles last week. But I think mixed signal still holding here. Distillate inventories are still raising, okay, which suggests demand in some fuel sector may be weakening. Right, so if you still remember, last Thursday, right, the Fed just cut rates by 35 bips, which helped the overall demand outlook, but it's still cautious. I mean, the cautious still limits how much upside we are getting, right? So I think technically price supports looks good now, but the resistance is likely near the month's high, unless demand surprises upwards or supply risks gets worse. So I think we'll be watching closely the inventory data and also the OPEC plus move, for clues, right? So, but at this juncture, we're still holding a negative trading bias in our report, aiming for the 60 US dollar level, right? Um, so coming back to Malaysia, right? So the FKLI showed a modest pullback yesterday on Thursday, retreating from the earlier high. Well, it looks like the traders took some profit after the gains or the bull run, right? And also, I think global rate sentiment, inflation, interest rate likely nudged some cautious, right? So, there haven't been any big things happening right now pushing the sentiment, but however, the move down could offer a short-term, entry opportunity if support holds around uh, 1535 and also 15,000 level. So I think the key is now watching foreign flows incoming again into our market. Yeah, so as what I've mentioned yesterday, and also upcoming data, right? So I think overall we are still positive on the FKLI market. Right. So yeah, this is our watch list. Maybe if we were to write on the Nvidia Intel story, right? Well, it might have some spillover effect here. Maybe you guys can take a look at Great Tech, Penta, and some other tech names here, which we have. Okay. So moving on to our Malaysia trading stocks, we have Mr. DIY today that trigger our screener. So the stock has experienced a pending breakout formation and hit the resistance at 1.62 cent. So with that, we expect the momentum to remain bullish and the stock able to climb higher and break out this level at 1.62 cent to test the next resistance at 1.70, followed by 1.75 cent level. So if the counter break out below 1.55 cent and form a new low, so this could indicate a near-term pullback. Next we have Tenchong Motor. So the stock yesterday has experienced a breakout above the 55 cent level on the accelerated volume. So should the bullish momentum hold and continue to trend higher in the coming sessions ahead, the counter potentially climbing higher towards the next resistance at 60 cent level, followed by 65 cent level, where if it drops below 50 cent level, this will open the door for further correction phase. Right. Okay. So maybe if I can bring your attention to this one stock that have been trending higher and higher and has been in our radar for quite some time, right? Can see here, Southern Cable has broken all of our previous resistance at 195, 205, right? So now the pullback seems like it seems like that the pullback now have completed the cycle. However, if it goes deeper around 2 ringgit, right? No. So I think 2 ringgit should be the nearest support before it could rebound higher. I mean, according or referring to this Fibonacci retracement. Okay, so for now, do watch out for the 2 ringgit level and also 2 ringgit support level and also 2 ringgit 20 cent for the resistance. Okay, so for FCPO, well, it dipped on yesterday's session by 40 ringgit to close at 4435 on growing concern that supply is getting ahead of demand. Well, inventories in Malaysia are climbing, and although demand from India and other markets is helping, I think it hasn't fully caught up, right? So in short, I think if it looks, in short, it looks like a mix of oversupply worries plus also demand not yet strong enough to absorb the surplus. So I think we still hold a long position at this juncture unless it crossed below the 4,350. Also towards the upside, do watch out. Do look at 4,500 followed by 4,600 resistance. All right, I think that's all from me. Pass the floor to the next presenter. Thanks, everyone.
Hey, morning. Let's move on to Sunway. So yesterday, Sunway announced that it is acquiring MCL land from Hong Kong Land, and this total cash consideration is up to 738.7 million Sing dollar, or equivalent to 2.4 billion ringgit. So this at one times price to NAV, we think the acquisition is fair, given the synergy that the deal can bring to Sunway. And 3 of the MCL lands projects in Singapore will also be completed very soon, by end of the year. So the cash consideration comprises 5 projects in Singapore and also Wang Sha Walk Mall at 99% occupancy, as well as land parcels in Wang Sha Maju and Forest Heights Township in Seremban, which is a 50% JV project with UEM Sunrise. So apart from strengthening its presence in Singapore, the Wang Sha Walk Mall also provides a development opportunity due to unutilized plot ratio, 4 times for the project versus the utilization of only 0.9 times. So Seremban is also a new area that Sunway recently ventured to for a TOD. So currently there are about 70-80 staff from MCL Land, and Sunway will absorb all of them. The acquisition does not require approval from Sunway's shareholders and will be completed by 4th quarter this year. So the company is certainly bullish on the Singapore property market over the longer term. The acquisition is also timely, given that the market there has been going strong lately, and our property analyst in Singapore, Vijay, is of the opinion that 2025 primary residential sales volume will be about 9,000 to 10,000 units. That represents a growth of 30 to 40%. From the previous year. So through the acquisition, Sunway will be able to participate in more projects in Singapore at historical land cost, lowering execution risk compared to new land tenders. Moving forward, Sunway will continue to focus on mid to mid-high segment with ASP of 2.2 to 2007 Sing dollar per square foot price range. And management aims to establish a stronger brand equity in Singapore. So which means that over the longer term, they will gradually take over the MCL Land brand. So future land bidding with JV partners will be properly managed to avoid any potential conflicts. So in terms of earnings prospect, the acquisition will prevent an earnings blip following the listing of Sunway Healthcare that will happen in early next year, as 3 out of the 5 projects in Singapore will be completed by end of this year. The accumulated profit from this project would amount to about 100 to 113 million. So this will be more than offset the earnings, so-called earnings loss from the listing of healthcare. That will be about 50 over million per year. And the accumulated profit will be recognized next year. So we maintain our earnings forecast at this juncture, and Sunway will likely fund the acquisition almost entirely with borrowings, and the spike in net gearing possibly to 0.55 times will be temporary. The listing of Sunway Healthcare, which will result in revaluation surplus, as well as the profits to be returned from MCL Land projects, will help to ease gearing over the near term. So in terms of valuation, we impute the incremental value from of the projects from MCL Land into our RNAV estimate, and our target price is raised to 6 ringgit and 8 cents. And given Sunway's wider exposure to the burgeoning Singapore property market, we narrow our discount to RNAV to 25% from 30% for the property development segment. Our target price is now at 6 ringgit and 8 cents, maintain our buy rating. That's all from me. Let me pass to Adam, the next speaker. Thank you.
Okay, good morning everyone. So today we have a results note on Binastra Corporation. So they just released their first half FY26 results of 54 million ringgit, which was 31% year-on-year higher. But this, although it met 40% of ours and stretched expectations, we deem it to be in line given that we expect a stronger second half of 2026. So in terms of order book, it currently stands at about 4.6 billion as of August, compared to just 2 billion ringgit in July last year. And in terms of new job wins, it has secured 1.6 billion worth of new jobs, and it remains put with its 4 billion new job win target for FY26. So therefore, Binastra would need another 2.4 billion ringgit worth of new jobs to hit the 4 billion target for FY26. So how would they then try to reach this target? So this would mainly come from Johor Bahru based projects, particularly from Exim and Maxim. So for example, Exim has about 1.4 billion worth of main construction works for the Causeway Square project, which is near RTS. And recall that Binastra won a 132 million contract for the piling works. Also, Binastra also won some piling works for a project by Maxim Global called The Address at Taman Pelangi in Johor. And the main construction works could be roughly about 800 million ringgit. So 1.4 billion from the Causeways plus 800 million from The Address have about 2.2 billion worth of potential construction jobs, which could likely be awarded by end of FY26. Additionally, we understand that Binastra is also looking into the EPCC of solar-related projects, particularly related to LSS5, but that has yet to be finalized or even awarded. But we reckon, it could be somewhere between 100 and 200 million ringgit worth of potential contract value. And they are also looking out for private renewable energy related projects, especially given that they have incorporated their EPCC renewable energy construction arm called Binastra Green Energy. So all in, given that results were within our expectations, no changes to our estimates, maintained by financial target price of 2 ringgit and 64 cents. Relating catalyst, would be if Binastra were to secure new clients aside from Exim, Maxim, and Platinum Victory, and also secure new data center projects. So that's all from me. I'll pass on the floor to my colleague Eddy. Thank you.
Right. Hi. Good morning, everyone. We do have. This is the last report for the day. It's the rubber products. We are maintaining our underweight stance on the sector. This is on the results, basically on the second quarter results. So June reporting quarter actually turned out weaker than expected. Main drag here was the 10-day disruption in the natural gas supply, which forced many manufacturers to halt production. And on top of that, there was some, the sector has faced some global shipping delays, as well as customers have chose to defer their orders because of uncertainties in the US tariff policies. Profitability-wise, it's further hit by a depreciating US dollar against the ringgit, which reduced export margins. And also, we see raw material costs soften, but the glove makers were unable to pass through the costs effectively. So as a result, the blended ASP for the quarter continued to decline sequentially. Out of the 5 companies that recovered, 4 actually missed expectations. Kosan was the only one that was in line with expectations, supported by better efficiency in its glove division. And during the results note, we actually upgraded Kosan to a buy. In terms of some of the key trends for the sector-wise, the sector sales volumes actually fell 4% Q-on-Q, but year-on-year basis, it was still up 17%. Encouragingly, only Top Glove and Riverstone managed sequential volume growth. So for a Top Glove case, the growth was mainly driven by US market, which saw a 24% Q-on-Q increase. this slightly more than offset the decline in the non-US market. For Riverstone's case, we also saw higher demand for generic products in the US, though these products actually carry a lower margin. Based on our track, we do estimate the blended ASP for the sector to range around USD $19 to $24.6 per thousand pieces. Top Glove at the lower end and Riverstone at the higher end. More importantly, the US ASP for generic medical glove actually stands at around $18 to $19, but it's remained under pressure and it's likely to continue to trend downwards. Moving on from the results review, we in the report we also touched on some of the trade dynamics. In July, the Malaysian export actually rebounded strongly, 64% up month on month. This rebound actually brought export volumes for the month to just up to 85% of pre-pandemic average compared to 52% in June. But we note that the recovery is actually, most of this jump actually went to the non-US market. As a result, US now only accounts for 45% of Malaysia's glove export, which is down sharply from 75% back in June 2025. But overall wise, in terms of Chinese capacity in Southeast Asia, channel checks suggest that new Chinese capacity in Indonesia will start operations in October this year, which is next month. So we believe the factory visits are already ongoing, and typically for large buyers, right, after the factory visit, they do need to have some validation processes, and that could take around 5 to 8 months before large orders are placed and significant shipments begin. Yeah, so there's a risk where these Chinese capacities outside of China, which specifically in Indonesia, they are catering for the US market. So in terms of pricing wise, these plants actually enjoy cost advantage in our view, thanks to newer and more efficient lines, as well as the use of cheaper biomass, as well as coal-fired coal-fired heating instead of natural gas. While their costs will never be as low as those in mainland China, we estimate the generic glove from these factories could still be $1 to $2 cheaper than those made out of Malaysia. So all in all, competition will set to intensify further, particularly in the US. So I'll skip everything else and jump straight to valuations. So for sector valuations, it may look cheap on the surface, trading at just 0.76 times forward price to book, which is at negative 1.4 standard deviation below its 3-year mean. But we do see this discount as justified. It actually reflects the structural headwinds rather than a buying opportunity. And looking at consensus numbers, we do think that forecast is a bit too optimistic relative to operating realities. So we believe that there is risk for further earnings disappointment in the coming quarters. Therefore, we are maintaining our underweight stance on the sector. Our top pick, we only have one, which is Riverstone. We think its exposure to clean room gloves as well as the semiconductor recovery gives some resilience to it. And it also have a consistent dividend payout, which for FY26 is around 5% yield. Other buy calls include Kosan. We like it because there is efficiency driven margin improvements. But we are keeping our sell call on Kata Lega, Top Glove as well as Supermax. Some of the key risks here to our call, it's a structurally stronger US dollar, rebound in glove ASP, as well as faster than expected capacity expansion, as well as steeper raw material prices falling further, basically. That's all from me. We'll see you the same time next week. Thanks.